Natural gas is the world's fastest growing major fuel, prized for its lower carbon footprint, versatility, and pivotal role in the energy transition. Over the next 15 minutes, we'll explore its production landscape, demand sectors, recent price dynamics, and the strategic mindset guiding both institutional and retail investors. Global supply, abundant but geopolitically complex. Total proved natural gas reserves exceed 200 trillion cubic meters, TCM, enough to meet current global consumption for roughly 50 years. Annual production reached about 4,200 billion cubic meters, BCM, in 2024, sourced from United States, 33% of global output, led by shale plays in the Marcellus and Permian basins. Russia, 16%, relying on legacy fields in Western Siberia and expanding Arctic projects. Iran and Qatar, 6 to 8% each, with the world's largest gas liquids projects. Middle East, China, Australia, and Canada, 5 to 7% each, combining onshore fields and LNG export terminals. Despite ample reserves, pipeline constraints, political embargoes, and LNG shipping bottlenecks create regional supply tightness. US export capacity through 6 LNG terminals reached 120 BCM year by mid-2025, yet global demand for flexible LNG cargoes outstrips available volumes. Demand powering industry, homes, and beyond. Global gas consumption hit 1,400 BCM in 2024 and is forecast to grow to 4,500 BCM by 2027, driven by power generation, 40% of demand. Gas-fired plants provide flexible baseload and peaking capacity, balancing intermittent renewables. Europe and Asia expanded gas to power by 8% in 2024 to replace retiring coal and nuclear units. Industrial use, 30%. Fertilizer, ammonia production, petrochemicals, and steelmaking via blast furnaces rely on natural gas as feedstock and fuel, consuming over 1 to 200 BCM annually. Residential and commercial, 20%. Heating, cooking, and hot water demand, especially in cold climates, accounts for roughly 800 BCM, with Russia, Europe, and North America leading per capita consumption. Transportation and LNG marine, 10%. Compressed natural gas, CNG, for fleets and LNG-fueled ships grew by 12% in 2024, as regulators favor cleaner maritime fuels. Price drivers and recent volatility. Henry Hub spot prices averaged 350 MMB2 in 2024, then spiked above 6 MMB2 in early 2025 following weather extremes, a colder than expected 2024 to 25 winter in Europe and Asia, depleted storage inventories, tightening markets. Geopolitical disruptions, supply disruptions from Russia-Europe transit disputes and outages in African LNG exporters reduced available cargoes. LNG demand surge, Asia's gas-to-power ramp and new spot buyers in South America absorbed incremental LNG volumes, leaving spot prices in backwardation. Coal-to-gas switching, high coal prices and emissions regulations accelerated switching in power generation, lifting gas demand. Unlike oil, natural gas pricing is highly regionalized. US prices, Henry Hub, European hubs, TTF, NBP, and Asian LNG spot rates can diverge by 210 MMB2 based on pipeline flows, shipping economics, and storage levels. Institutional versus retail exposure pathways. Institutional investors employ forward curve strategies, basis trading between regional hubs and CFTC-regulated futures on Henry Hub, TTF, and JKM. Allocate via energy infrastructure funds, investing in pipelines, LNG terminals, and storage assets offering stable cash flows. Hedge corporate gas exposures for utilities and large consumers using swaps and options. Retail investors access via natural gas ETFs, UNG, energy sector mutual funds, or leveraged E-mini futures contracts. Face roll yield costs in spot-based ETFs due to contango in the US curve. Can trade short-term volatility around weather forecasts, inventory reports, EIA weekly stocks, and seasonal demand shifts. The natural gas investment mindset for retail investors. A 3 to 5% allocation to natural gas or energy infrastructure can diversify portfolios and hedge inflation and rate-sensitive sectors. Seasonal strategies, long before winter and short after spring, capitalize on predictable demand cycles. Volatility management is critical. Expect 30-50% price swings around extreme weather or geopolitical events. For professional managers, energy infrastructure, pipelines, regasification terminals, storage offers regulated or contracted cash flows with 5 to 8% yields. Basis arbitrage between Henry Hub and Asian LNG can generate returns above 10% but requires shipping and credit expertise. ESG considerations drive selective investments in low methane leakage projects and renewables-backed gas facilities. Key investment reminders. Regional dynamics, prices and fundamentals vary vastly across North America, Europe, and Asia. Understanding basis risk is essential. Seasonality. Gas markets exhibit strong seasonal patterns. Winter and summer peaks create reliable trading windows. Infrastructure constraints. LNG shipping capacity and pipeline bottlenecks can cause localized shortages even in global surplus conditions. Environmental policies. Methane regulations and carbon pricing can materially impact supply costs and demand growth. Storage role. Inventories act as the market's shock absorber. Tracking weekly storage levels provides actionable signals. Summary and strategic takeaways. Long-term outlook. Natural gas demand growth continues through the energy transition as a bridge fuel, though high methane leakage regulations and competing renewables pose headwinds. Investment thesis. Regional pricing disparities and infrastructure bottlenecks create multiple arbitrage and yield opportunities, while seasonality and weather drive short-term volatility. Portfolio considerations. Strategic allocations to gas futures, energy infrastructure, or ETFs should reflect risk tolerance, basis exposure, and time horizon. Timing strategies. Capitalize on seasonal peaks, hedge against extreme weather scenarios, and monitor geopolitical developments in key supply regions. Natural gas remains a dynamic asset class at the intersection of commodity markets, infrastructure investing, and environmental policy. Whether for yield-oriented infrastructure or directional gas price exposure, mastering regional fundamentals and seasonal patterns is the key to success. Thanks for watching. Share your thoughts below, like, subscribe, and hit the bell icon for more energy market analysis. See you next time.